Welcome, ladies and gentlemen. So today we have a very interesting guest here in our Property and Finance podcast at Shore Financial. We have Michael Blythe, who has been a Chief Economist, you could say, for close to 40 years, two occupations of which were at very interesting organisations, you could say. One was the 13 years at the Reserve Bank of Australia, the RBA, as their senior economist. And then after that, for 23 years at the Commonwealth Bank of Australia as their chief economist. So, Michael, welcome aboard.
Well, thank you very much. And those are kind of scary numbers in some ways, and it gets even scarier when you work out how many GDP and CPI releases that is and how many Reserve Bank board meetings that I've had to sit through as well.
How much data you've had to digest
yes.
in those decades. You've seen many interesting times like these. There's some crazy headlines out there talking about, record high rates and record crazy inflation or record mortgage affordability issues. But that record refers to when we were actually recording things like the mortgage index and interest rates and affordability, which only goes back to about 1990, right? So you've been seeing things a lot prior to then in the 80s when the infamous, record high 18, 20% interest rates were around. Well, firstly, just to recap, it's been a crazy couple months since we last did our Property and Finance podcast. The forecast of interest rates just changed overnight in the last couple months. Back in September, we were expecting rates to come down early next year. Well, CBA in particular, their chief economist was forecasting that the first rate cut would be March. All the other major banks weren't far behind, all sort of forecasting around mid next year. Then all of a sudden, the US Federal Reserve came out and said, no, we've probably got one or two more rate rises to come. That overnight changed the global bonds forecast of interest rates and when the world is probably going to start seeing rates come back down. It went from being sort of mid next year across the world to maybe even early 2025. It really took the wind out of the sails in the housing market in terms of buyer confidence and consumer sentiment. I was actually surprised how quickly the average consumer reacted to that change in forecast. Everyone was quite aware of that interest rate sort of change as such. So lots has changed. We've seen what we've seen internally in our business on the front line is that people have gone from being confident about making decisions and thinking now is a good time to transact to now being a little bit more nervous about rates staying high for a while and what that might mean for the property market in 2024. So I feel that buyer fatigue that normally comes in around December when people sort of check out and stop looking at properties because of the festive season as such. It started a little bit early this year. It started in November. Interesting time. So Michael, you've been through a lot of these crazy ups and downs and swings, you could say. So, well, what's your sort of take on what's going on out there in the world right now?
Well, economists learns early on in their careers to forecast early and forecast often because it's surprising how many times you get this kind of scenario where you think the path ahead is pretty clear, all appears to be on track, then something comes in and shifts direction and you have to adapt to that pretty quickly. A couple of issues really I think that are playing out here, but the one that's worth probably talking about at the moment I think is we do have a new Reserve Bank Governor, Michelle Bullock, been in the job for a couple of months, and over that couple of months it's become apparent that her approach to monetary policy, to interest rate setting is going to be a little bit different than her predecessor, who was the one that kind of put in that pause that we've had in rates up until then.
Elaborate on that. In what regard do you mean by that?
Well, I think what's happening is she's still, obviously, as part of the job requirement, firmly committed to the Reserve Bank's inflation target, which is to keep inflation somewhere between 2 and 3% over time. But the little bit extra that she's added to it, I think, is the degree of toleration for how long it takes to get back to the target band. Now, we're already 20 months into a period where inflation has run above that 2 to 3% target. If you look at the Reserve Bank's forecasts, what they're really saying, they won't be back in that band until 2026.
Well, and that's something else that also changed, right? So going back to the changing landscape in the data that's come out in the last couple of months, it was looking up until around September, it was looking like inflation was steadily decreasing. I think people were confident that the rate rises were working, that they were easing inflation. But then in October, the monthly CPI indicator sort of indicated that inflation was being a little bit stubborn, right?
Yeah, that's right. So that's part of the process. Stubborn, sticky inflation, call it what you will. It's going to take longer to get back to the target band, too long. And so, of course, you've got to make it happen faster. Higher interest rates is the way if you're a central bank that you do it. Yeah, but the inflation story, though, I think is also an interesting one at the moment because it's really a two-part story. Now, what we've seen and what's driven that slowdown in inflation so far is the good side of the equation. That's slowed dramatically. But we haven't seen much of a slowdown in services inflation whatsoever. It's still running close to record highs at the moment. So
that's interesting. Is that mainly maybe because services are correlated toward labour and there's a low unemployment and people need a certain income to live in this crazy rising inflation environment?
Yeah, it's a common global theme. Inflation is proving difficult to get down in a lot of countries, and it's because of high services inflation. What's the kind of common global thread, economic thread behind that? And it is a bit of a pickup in labour costs. I mean, services are mainly about labour, so what happens there is absolutely critical. But again, Australia is a little bit different. The biggest component or the stickiest component of services inflation in Australia is actually housing, the housing component of the CPI. And I don't think many people are aware, but housing is actually a bigger share of the consumer price index than things like food, which you kind of think it would tend to dominate those measures of what we spend our money on. But it's housing with the biggest share. And of course, because house prices are doing what they're doing, which has bottomed out sooner than people thought and have certainly gone up faster than people expected in 2023. And that's feeding back into the CPI. It's one of the things that's making it hard to get that kind of final step down inflation that the Reserve Bank is looking for.
So when you're talking about housing, because we did have some previous guests here from CoreLogic and Domain talking about this this contribution of housing toward the inflation figure. There's two elements to that, right? Correct me if I'm wrong. I believe when you're talking about house prices, it's new housing. Is that right?
Yes, that's right.
It's brand new homes that they're building, and the other on the rental side, it's obviously the cost of rent, right? It's not actually established properties.
No, that's right. So it's house purchase costs. So that would include the cost of buying an established property. So it does kind of feed in indirectly that way. But when you think about it, a lot of those housing-related inputs are related to house prices. So your council rates go up as the land value increases, for example. Rents typically follow the CPI, although, of course, a bit different at the moment given the squeeze that we're seeing in the rental property market. But all these things feed into the CPI. And they're not so easy to control. Come back to the Reserve Bank again. The only tool they have available to try and influence that part of the story is interest rates. And it was interesting in their statement after that rate rise that house prices were referred to particularly as one of the indicators they'll be watching very closely from here. And I suspect that's because of that kind of correlation and flow through into the overall inflation story.
Well, that tool they have does seem to take a serious effect on those factors as such. But on that note, let's go back to this article that came out this week in the Sydney Morning Herald about mortgage affordability being the worst it's been since 1990. And once again, that was because that's only that the records go back to 1990. Apparently in Sydney, if you take a median house price that we have now of 1.39 million and an average household income these days of 150 grand, they say that in Sydney, over 3/4 of household income is now going towards servicing mortgage repayments, which is quite significant. That is a huge number. In Melbourne, it's a little bit better. In Melbourne, it's about half of the overall household income going towards servicing mortgage repayments. What's your take on that? Is that a scary figure, or is that just a short-lived figure just to put the shock stop on inflation that we're not quite seeing yet? You've been through worse interest rate rises in the 80s. How do you interpret what's going on right now?
Yes, I mean, if you have debt and you're paying the market rate, then I've no doubt at all that it is a squeeze. The fact is, though, 1/3 of the population have a mortgage, so the rest are not really affected by what's happening with the interest rate story as such, to the extent that large part of that other group have actually savings, so they're benefiting as deposit rates have gone up. So when you kind of put those two things together, the average household is being squeezed, and not just by mortgage rates. We have a cost of living crisis going on at the moment as well. But it does tell you that the stress, if you like, is in a pretty narrow part of the overall household sector.
I have to say the media do love, harping on about the negativity of certain things rather than the positives as such. And to your point, you're spot on. This example was actually given on a mortgage interest rate of 7.2%, which is very rare. That if you're paying 7.2%, you're at least 1% above market. And on top of that, it's based on the fact that you've only paid a 10% deposit, which is also rare. So it is focusing on a narrow part of the market, like you rightly said.
And I mean, if we look at the interest rate story in particular, yes, you pick the headline figures, the reference figures, and it does look ugly. But what is interesting, I think, is that households have actually found a way to not so much offset the pain, but at least reduce it to some extent. So right now, refinancing activity is running at record highs, and that refinancing is going on at rates that are significantly below the reference rate, the headline rate there. So we look at the figures. Reserve Bank has lifted the cash rate by more than 4 percentage points, but the average rate on outstanding home loans has gone up by nowhere near as much. So the average interest rate pain is not as bad as those headline figures would suggest. A bit of competition in the home loan market has also seen the banks pass on a bit less than what the Reserve Bank has done anyway. But people are being proactive. They are taking steps to keep that interest rate story in check. And if we dig a bit further behind the scenes, what we can see is that Australian households hugely increased their savings during the pandemic era. A lot of that government handout was actually ended up in people's bank accounts, in their mortgage offset accounts. And on my calculations, that excess savings right now is about $300 billion. Now, that's a pretty useful cushion, not just for those who have a mortgage, but those that are facing these cost of living pressures as well. And we've been through a lot of bank results recently as well, and one of the standout features in those results is that just how far ahead some people are in their home loan repayments. Years in some cases.
That's a really valid point. So we in previous podcasts we've shared both the RBA and ABS data showing that people accrued more savings against their home loan, either in their redraw or their offset account, in that COVID era, that pandemic era through 2020 and 2021, more than ever. And hence why we probably have an inflationary and consumer spending problem. People, weren't in Australia able to really leave the country, weren't able to spend much, and they accrued a lot of wealth against their home, and interest rates were record low. The ability to spend money was limited, and now we've got sort of record high rates, but people aren't actually adjusting things in a way that seems desperate as such. So a lot of people out there are saying, "Oh well, households must be hurting." What we're seeing is actually that people are still leasing new cars. There's still good consumer spending out there. There was some data released in that last podcast that we discussed with CoreLogic around discretionary spending still being high. People haven't actually made the cuts that they would need to make if they were desperate. There's still, sort of buttons they can push to bring household spending in if things do get tough. Is that what you're sort of seeing?
Yeah, and in a similar vein, I mean, every Qantas plane that leaves Australia seems to be full of people who are going off on expensive overseas holidays. So, very clearly there's a distribution here. At one end, there are people who really will be suffering in the current environment, but they're obviously a small enough part of the total that the overall picture doesn't look that bad. We have seen a bit of an interesting shift, I think, in the consumer spending side of the story, though, and this is a little bit technical, but the consumer price index that we all focus on, it's what they call a fixed weight index. It assumes that we buy the same things every week. But there are other price measures that are called implicit price deflators, and they change with what our spending patterns are, so what we actually buy every week. And what stands out is the CPI has been growing at a much faster rate than this consumption deflator. And what that tells you is that people are actually shifting their spending patterns towards cheaper items. So, behind the scenes, again, there are these adjustments going on that have kind of made it more bearable than you would think just by looking at those headline interest rate and mortgage rate type numbers.
And I think we've to elaborate on that, I think there's been a decrease, for example, in people spending money at restaurants and going out for dinner, and an increase in supermarkets and grocery sales. So what does that tell you? People are saving in that way. They're cooking at home more, and they're not spending money on lavish nights out as such.
Yes, I think that's right. So as I say, there are changes going on behind the scenes that are hard to see in a lot of ways unless you kind of really dig into the numbers, but it does again tell you that we are doing things to try and lessen the pain.
But they still have a bit of a buffer, is what I understand. There's still steps people can take to rein it in further if the pain gets to a point in which they need to consider selling their home. There's a few steps between that consideration as such. All right, so Michael, the other thing that is spoken about quite a lot is this monthly indicator of CPI versus the quarterly figure that comes out, which is the annual rising inflation, I think, reported quarterly. Like I said, in September and October, the figures that came out weren't as appealing, you could say, as that we were hoping. Inflation sort of still stuck around that 5.4, 5.6 level. It actually rose, I believe, month on month at one point, which I think was mainly correlated to a 20% increase in oil prices since July, and I believe petrol prices make up almost 10% of the overall CPI figure, I believe.
Oh, it's more like 3 or 4%. It's actually declined over time, of course.
Fine, that's good. Yeah. So, what's the big differences between those two figures that everybody focuses on?
Yes, well, Australia is one of the few developed countries to only have a quarterly CPI. The other country is New Zealand. So the demands from financial markets, demands from the Reserve Bank have been for a long time to develop a monthly CPI indicator. And a few years ago, the Bureau of Statistics obliged, and we now have this monthly CPI. It's important to remember, though, it's not the same as the quarterly CPI. It covers a subset of prices that appear in the quarterly measure. The ABS is able to use what they call kind of partial indicators to kind of extrapolate some of the price trends from month to month rather than just from quarter to quarter. Now, over time, you'd expect or you'd hope the two lines would move pretty closely together, and they do, but you do get these occasional divergences. And it does raise, I think, an interesting point when you're thinking about what does inflation mean for monetary policy. If we think about it, the annual inflation rate is really just a sum of the 12 monthly price indicators or price movements that you add up to get the annual inflation rate. But what it does mean is that annual inflation may reflect what's happening right now, or it might actually reflect what was happening a year ago. So if an unusually small CPI increase from a year ago dropped out of the calculations and you've added on a slightly larger increase at the other end, it looks like a big increase in inflation. It's got actually more to do with what was happening with prices a year ago, which is not really relevant for interest rates.
But it's still being factored in.
It's still being factored in. But you can fiddle around and reconstruct that annual inflation rate and come up with what people are calling instantaneous CPI measures. All it really means is instead of putting the same weight on every month, you put a higher weight on the more recent readings on inflation. And when you do that, what you get is that the last few months it does look like the inflation rate has been picking up rather than slowing down. And this perhaps is another factor that's fed into that Reserve Bank to raise interest rates at their November meeting, and obviously why the bias is still towards further rate rises as well. So, as always, getting behind the data, thinking about how you can interpret it or how you should be interpreting it is pretty important when you're trying to draw out the policy implications there as well.
It's interesting on that comment of the petrol prices. The media has really sort of highlighted that the oil's prices and petrol prices have been such a major contributor to that increasing inflation, or that stubborn inflation, I should say, around September, October. But if it's only 3%, it's clearly all those other factors that are still an issue.
Yes, well, that's right. You know, in the end, we can construct all these various underlying measures of consumer inflation, take bits out, add bits in, reweight it, whatever you like. But you can only do that for so long. I mean, how many times do you need to see an outsized increase in inflation, to say in petrol prices, for example, to say it's not a one-off, but it's part of the ongoing inflation story, which in the end is why the Reserve Bank's inflation target is specified in terms of headline inflation. So the CPI that includes everything, doesn't exclude anything, includes the whole lot. That's the part where we're still struggling to get the sort of traction that clearly policymakers thought they would have had by now, proving elusive, and so we need to tighten the screws a little bit further. And the Reserve Bank, I think, seems fairly comfortable in doing that. I mean, to go back to the household story for a moment again, because they think the household sector is actually dealing with that pain quite well outside of those instances where people are feeling the stress. And it reminded me, in a way, we spent a lot of time a few months ago talking about this mortgage cliff that we're all about to topple off the edge off as all those very low fixed rate loans from a few years ago rolled off and people had to refinance at a higher rate.
The infamous mortgage cliff.
And again, we look through all those bank profit announcements and so on recently. It's pretty clear that we're more than halfway down that cliff, and we haven't. We've managed to do it somehow without that disastrous ending that most people were expecting to see.
Yeah, let's put some numbers on that. So there was $370 billion in fixed rate mortgages coming to expire, or fruition, you could say, between June this year and June next year. But the bulk of it was the first 6 months of that financial year. We're definitely through the thick of it. I believe it did correlate to an uptick in new listings in July, August. Domain and CoreLogic did support that as well. There was about a 14-15% increase in new listings compared to the 5-year average, not compared to last year being record low levels, compared to the actual 5-year average. What's ironic, if we do compare to last year, we have more stock, more auctions on every Saturday in this spring selling season. However, clearance rates are actually up. So there's more supply, but stronger demand, higher clearance rates, which is interesting. We'll move on from inflation because I'm sure everybody's sick of hearing about inflation. The other big one has been spoken about a bit in these podcasts as well, but I want to touch on it again. Migration and this whole supply of housing and how it correlates to demand, and how does, the role of population growth and migration, how does that help shape the housing market, especially in Sydney?
Sure. Well, there's a number of channels there, really. Of course, it's the numbers. You've got people coming into Australia, and at the moment that annual migrant intake is running at an extraordinary 400,000 people plus. These are numbers that we've never seen. Part of that,
400,000 every
12 months. We've never seen numbers like this before. It's partly catch-up, of course, because the borders were shut for a number of years. There weren't any migrants coming through at all, so it's just a bit of a surge that's working through the numbers. But, even if we go back to a normal year, we're talking 200 to 300,000 migrants coming to Australia. So, there's a big chunk of housing demand coming through. And what accentuates that is a lot of those migrants are, in fact, skilled migrants. So they are actually cashed up when they arrive, and one of the first things they want to do, of course, is get into the housing market. So
that's the most common sort of conception, where people think that we're sort of opening up the floodgates to, I think there's 800,000 people coming by July next year, and people assume that there's 800,000 backpackers coming to work in all the bars and pubs and hospitality, but it's not. They're skilled workers. They're the skilled workers that we need. They're industry specific, and some of them are coming here cashed up, ready to transact.
it's a pretty simple calculation, really. We know that on average in Australia there are 2.4 people or thereabouts per household. So it's pretty easy to work out the demand for new housing from those kind of population type numbers. Right now, construction activity is running nothing like that. In fact, we're having a bit of a construction recession, really, and all the leading indicators say we haven't hit bottom there yet. So at the same time, we're pushing up that demand with immigration in particular. We're actually reducing supply as a lot of construction companies we've seen have struggled to stay afloat. Some have gone out of business. Insolvencies on the construction side of the economy are running at record highs at the moment. So we're just physically not able to build the level of housing that we need to accommodate the population flows we're seeing at the moment. That's flowing into the price story without a doubt, particularly in Sydney, because if you're a migrant, if you come to Australia, nearly all of them start off at least in Sydney or Melbourne. That's why those markets always move more and sooner, I think, than you see elsewhere. But there's another, I think, really critical part of the story here that people don't appreciate. We talk about the housing market, but the housing market isn't like any other market. If you walk into Coles or Woolworths, everything you see is for sale, and you can buy it. But it's not true in the housing market. If you look at turnover, how many houses do we buy and sell each year? It's somewhere between 6 and 8% of the housing stock. If you look at new construction, it's typically adding 1.5 to 2% to the housing stock each year. So what it's saying, in any 1 year, only about 10% of the housing stock is up for sale. The other 90% is effectively locked up because people aren't interested in selling or moving or whatever. So it doesn't take too much of a shift in supply and demand against that small bit of the market that's liquid to have a big impact on prices. And that's why I think people always kind of underestimate how far prices can rise, and equally why they always overestimate how far prices can fall during the down cycles as well, because the housing market is just not like any other market.
Can we go back to this construction recession? Because that's an interesting topic, because a lot of people we're seeing are definitely nervous about buying a house that needs renovating. There's definitely a demand for the brand new renovated homes versus the unrenovated homes because of all the hysteria that was around for a couple of years around construction costs going through the roof. The lack of being able to even source a builder was an issue. So we've seen that what the data showing across Sydney in the last 12 months is there's been roughly about a 30% decrease in DA submissions across most councils across Sydney. 30% less people, 30% less volume of people applying for approvals to renovate their homes. Once again, there was an article that came out about 3-4 weeks ago on the AFR that mentioned 1/3 of medium-sized home builders trading in a negative cash flow at the moment. That's mainly because a lot of those builders have agreed to fixed price building contracts a year or two ago, and the goalposts change on them. All their costs change, but they've agreed to contracts they need to honour, so they're running these jobs at a loss. What's your thought of how we're going to come out of that sort of construction recession as such, and what should people sort of look out for?
As I say, it's going to take a while, I think, because there are those long lags between when a lot of those contracts were signed and when construction starts, and when the problems become apparent, and the leading indicators like local government building approvals, as you mentioned, they are still falling at the moment. So the end's not yet here. And that's important for the economy as well, because that new construction has a big kind of multiplier effect on the rest of the economy. Because you build a new house, you've got to fill it up with new furniture and carpets and things like that. So it flows right through the
There's so many jobs and workers tied up into it.
Absolutely, yeah. So, and the people who look at these multipliers, as they like to call them, basically the numbers are every dollar you spend on residential construction generates $1.34 worth of spending somewhere else in the economy.
Because it's not just the shopping in furniture to decorate the house, but it's all the suppliers for manufacturing the house as such. Yeah. All the materials. There's a domino effect as such, right?
Yes. So, the construction story is very important. As I say, the leading indicators are just not showing any sign of bottoming out just yet. More positively, I suppose, in a sense, where those indicators are around about the levels that were the bottom in previous downturns. So it doesn't mean to say there's going to be an automatic jump back up in construction activity, but at least a lot of the downturn is probably in place. And I think in the end, the new contracts that are being signed today, they're going to reflect where construction costs are right now. And it's pretty clear growth in those construction costs is slowing pretty quickly at the moment. So we're kind of getting to a more favourable backdrop for new construction to come through, I think. So I think we will see a turn up, particularly given the demand side of the story there. It just has to basically respond to the strength of that demand.
And what strategies are there normally for both federal and state government in these situations where, 2 points, supply has dried up a long time ago, actually. Supply of new housing in New South Wales in particular. It started easing, I think, about 5 years ago. And it's only gotten worse. And you can forecast what the supply will be based on development approvals. And I'm not talking about development approvals for mums and dads renovating their homes. I'm talking about larger scale development approvals for house and land packages and brand new units. And it's the forecast is of supply is not looking good, really. So what strategies we've seen? The state government recently released that housing package as us to try and build, I think it was 1.1 million homes, was it, in the next 4 years? Yeah. Which seems like a challenge in itself.
I would like to see that. I mean, it would be the biggest construction period that we'd ever seen. And normal construction's more like 100 to 200,000 a year. If you want to add extra on top of that, then I think it'll be difficult to achieve.
Yeah, so basically, are you saying there's not much else they can do apart from make these promises they just hope to commit to?
Yes, but there are a lot of other things that can be done, I think, if people, or if governments in particular, have the nerve, if you like, to push in that direction. And to be fair, there are some steps going on here, but we talk endlessly about this national housing crisis, shortage of supply and so on. But what most economists would tell you is we don't have a shortage of housing in Australia. We actually have an excess of bedrooms. If you look at the data from the last census, the 21 census, there's something like 13 million empty bedrooms in Australia, but they're just in the wrong spot. Yeah. They're typically in those large houses that are held by older age groups who've lived in them for a very long time, and of course the usual kind of household cycle rolls on with kids come along and the house is fully used, and then of course the kids leave, come back, but then they generally do leave. And so all of a sudden you've got this excess supply of bedrooms. Older households in older houses as well, where maintenance costs rise, running costs rise. They need assistance with the gardening and maintenance and the like. So what you've actually got a group who you really need to encourage to move to something that's more age appropriate. If downsizing. And this is, I think, a great policy opportunity that governments are really just starting to take advantage of. And I give full credit to the Commonwealth Government with their superannuation scheme, where if you downsize as an individual, you could put $300,000 into superannuation. As a couple, you can put in $600,000, and it's a great way to boost your income because that super earns money. It kind of protects your assets if you want to leave something to the next generation, for example. It's very tax effective as well.
So yeah, let's elaborate on that, because that is a fantastic scheme that no one really is across. So at 55 years old is the qualifying criteria, I believe. It's $300,000 per person from the sale proceeds of your home.
Yes.
And so that means you could put $600,000 of your sale proceeds of your home, if you're a couple, into your superannuation tax-free. On top of that, you still get the contestional and non-contestional contributions. So with the non-contestional contributions, you're allowed $110,000 per year, and you can bring it forward 3 years at once. So you could, if you're a downsizer selling a decent-sized home, which most downsizers have a significant amount of equity in their home because they've been in the property market for an extended period of time, you can put up to $1 million quite easily into your super, which is probably what's needed as you're approaching retirement. Because if you assume a 5% return on a $1 million super fund, let's just say, that's $50,000 income, which, yes, once you are in retirement, it's tax-free. If you also do have a property in your super, it's CGT or capital gains tax-free, that is. So people need to probably put that amount of money in their super to plan for a comfortable retirement, right?
Absolutely. Now, you've got this big fixed asset that's not really generating any income for you, and here's a great way to maintain your wealth, but boost your disposable income. It's a kind of a no-brainer in many ways. But when we look at the numbers, I mean, this scheme's been going since 2018. And less than 60,000 people have taken advantage of it so far.
Because no one knows about it.
It's the superannuation's best kept secret. So,
what we've also found, there was some a gentleman, Bernard Salt, who is the House of Demographic Data, I think his business is called. He went on a roadshow outlining how most people there's a big shift toward self-employed practitioners. So a lot of people in many industries are moving toward being employed from a company to being self-employed, working on a contractual basis, maybe for several companies. Happens in every industry. That's why we've got these WeWork spaces popping up everywhere. Now, the problem with that shift to self-employed, sort of a self-employed workforce, is that superannuation becomes voluntary. If you're paying yourself a salary, sure, there's a super contribution that you need to make on that wage, but you don't have to pay yourself a salary. You can pay yourself a distribution or director's fees or whatnot. And most people do avoid. They have a short-sighted view, you could say, and thinking that, well, I'm 30, 40 years old. I'll worry about my super later. And right now, I need the income, the full income from my profession to service my mortgage repayments or to buy a home, because there's other challenges they're facing, right?
Yes, exactly that. I mean, superannuation is one of those things you only kind of worry about at the last minute, and by then it's kind of too late to do a lot about it. This downsizing initiative is one way. People need to know about this, but the biggest, well, there's two complaints that you hear about potential downsizers about why they don't do it. One of those is the cost of moving, which brings the stamp duty story into play, because that's the biggest cost of moving. And the other is they can't find the kind of type of dwelling that they're looking for where they want to live. And I mean, this surprised me when I came across this statistic, but when people move, 23% of them move within the same postcode. More than half move no more than 9 kilometres from where they live. So there's that kind of centre of gravity there that holds people. So developers need to understand this, and local governments need to understand this as well, to allow the right type of dwellings to be built. And the stamp duty story, I think, is because, to the extent we talk about housing in Australia, it's always about what can we do for first home buyers. So there are various stamp duty concessions for first home buyers. But maybe what we should really be thinking about is a bit of assistance for last-time buyers. And you kill a few birds with one stone that way. Now, these are people who are already in the market, so they're not kind of adding to demand and boosting prices. They're just kind of moving from one dwelling to another. By doing that, you're freeing up the big dwelling that first-home buyers, kind of more interested in as well. So it's another way you can help the redistribution of this excess of bedrooms and deal with the housing crisis. So it's not necessarily about building, hundreds of thousands more houses to try and keep up with the flow of population and the like. We need a bit of kind of innovation, if you like, in the way we think about some of these problems.
Well, that's sort of a good segue to, I guess, a changing demand that we're seeing across Australia, or let's just focus on Sydney, with what homeowners, purchasers, buyers, downsizers, first home buyers, all of the sort, what they're looking for now as a home. So there has been a bit of a shift in the apartment sector. Ever since COVID, I think ever since people had that traumatised memory of being locked up in an apartment and working from home as well, there's been a real run on houses versus apartments. Apartments did not see the same growth the last few years that houses did. Like I said, it's both from people probably wanting some space, but it's also that people now working maybe half the working week from home. So in saying that, they're also now willing to move further away from the city because they don't need to commute into the city as much. So people would rather a bigger house further away rather than a smaller house closer to town because they don't need to go into the office as much. I know here in North Sydney, Monday and Friday is basically as good as Saturday and Sunday. the working week I feel around here is Tuesday to Thursday. Thursday night is now the buzzing Friday night drinks. And the poor sort of cafes and restaurant owners around here are almost dead on a Monday and Friday. There's a real shift in habits, which is leading to a shift in demand in terms of what people want in the housing sector. What are you seeing on that note?
Housing preferences are changing, and it's part of the overall story. I think if we look over the years, the average size of a new house and a new apartment in Australia have just steadily got bigger, and not so much recently, but if we go back a few years, the big worry you used to hear about housing was it's overvalued. We look at prices compared with rents or prices compared with wages. This is unsustainable.
The real estate bubble.
The real estate bubble is going to
burst. Been hearing that for decades.
Yep. But part of the story is because the house part of the equation is different today from what it was 10, 20, 30 years ago. It's bigger. It's built out of more elaborate materials. It's more expensive. So inevitably, the level of prices has to reflect that, and unless we all want to go back to living in fibro shacks, then that's a permanent part of the story. And similarly, we were talking earlier on about the very high interest rates we saw in the 1980s, and the Reserve Bank was determined to crush that. And one of their arguments at the time about why they had to do that was for equity reasons. They had to get interest rates low enough that people who'd previously been locked out of the market for home loans could actually get one because the interest rates were that much lower. And on the estimates the Reserve Bank did at the time, that allowed about 600,000 extra people into the Australian housing market. Now that's a huge increase in demand compared with supply that doesn't change very quickly. So again, the level of prices is going to step up because of that. Unless we can work some way to take those 600,000 people back out of the housing market, it's a permanent feature of the story. And then you've got to overlay all those kind of underlying trends with that shifting housing preference, and it was interesting to see how things did evolve during the pandemic. The Commonwealth Bank constructs this thing called a regional movers index, and that based on their records, their home loans, they can see where people started from and where they end up over the course of a year and so on, and shows a huge increase in people moving to the regional areas of Australia for the sorts of reasons that you mentioned. Big impact on property prices at the time, and that was viewed as a permanent shift again for the reasons you mentioned. But their index since then has actually dropped back to where it was pre-pandemic levels. So it kind of looks more like a kind of a one-off shift in that kind of city to the region type move, but. Nonetheless, there's very clearly though that preference for a bigger housing, be it a unit or a freestanding house, coming through again.
Well, there was definitely a shift from city to the regions. We saw all those outskirts of Sydney, for example, flourish through COVID in terms of price growth. South Coast, Southern Highlands, Central Coast. Even they talked about the Chris Hemsworth effect in Byron Bay. I think Byron Bay recorded the most growth out of any suburb in Australia. Now they're contracting more than most sort of major cities. All those areas have had some price adjustments a bit more aggressively than places like Sydney and Melbourne and Brisbane. Sydney actually has been quite buoyant and strong, and we've had some good growth earlier this year. So, in saying that, we've spoken about a lot of data. Where there's a lot of topics we've covered. I'm going to put you on the spot here now. You've got 36 years tenure as a chief economist at the RBA and the Reserve and CBA. Crystal ball time, right? So much to digest, so much going on. We've even got wars going on, multiple wars around the world. What can our listeners, our homeowners, our buyers, our investors, investors are definitely coming back into the market we're seeing. I think the smart money sees higher yields and opportunistic buying at the moment. So what can all those individuals take from today's session and take from the data that we have at hand about what we might expect in the 12 months ahead? Are you of the same opinion that rates are going to stay high till 2025? Do you think the level of interest rates we are at now is is going to achieve what the federal government want to achieve with inflation, and we might see things starting to look a little bit more promising maybe mid next year in terms of house growth and the economy as such.
Mm-hmm. Well, I think the best guess for the broad economic story at the moment is we're going to see this period of below trend, below average growth that we've had extend through 2024. It's going to feel weak. In fact, it will probably feel like a recession to some people who are exposed to the negatives that are out there at the moment. But it's the kind of growth profile that means, yes, unemployment will go up a bit, but not by very much. And it's important to remember that the unemployment rate right now is near a 50-year low. We haven't seen numbers like this since 1974.
It's too low,
and it's from the Reserve Bank perspective, it's too low. But we keep generating these jobs despite weak growth, which suggests we're probably not going to see too much damage on the labour market front. So if you've got a job, then conditions aren't going to be too bad. And because unemployment probably won't go up as much as people worry about, it in a strange way becomes a positive shock to sentiment. It's bad, it's gone up, but it's nowhere near as bad as I thought. So therefore, things are better than I thought. And that we've seen this happen before. It flows back into the housing market, particularly if it gets reinforced by the idea of, yes, well, rates may go up a little bit further. Maybe there's another 1 or 2, but that's it. Again, the way
maybe another 1 or 2.
I've got one more of my own forecasts. Yeah. And that's because I think we're getting near the critical level. I mean, the big downside risk in Australia over the next year is a consumer recession. So we've got a construction recession at the moment. Maybe that's coming to an end. Consumer recession, though, and consumer spending is close to 60% of overall spending in the economy. If that happens, then everything goes down with that. What's going to drive it? Well, typically it's a lift in unemployment, but if we're not going to see much damage there, then you flow back to the interest rate part of the story.
But what's going to drive the increase in unemployment, right? So we are yet to see a drastic change in consumer spending, right? So once we start seeing a slowdown of the actual economy from higher rates, if we see a slowdown, that should trickle on to that potential concerns of a consumer recession, because if there's a slowdown in spending, there's businesses are becoming less profitable. People aren't hitting their bonuses as such. Businesses might need to have tough conversations with staff and say, I'm sorry, we need to reduce our expenses. Is that the concern of that consumer recession?
Well, this is the weird thing. Consumer confidence is working a lot in Australia. Business confidence hasn't. It's holding up at relatively robust levels, and that includes the kind of employment component where businesses are still saying they're looking to hire, not get rid of people. So it gives you a little bit of confidence on the labour market, I think. It's also important, inflation will slow further over the next year. Wages probably will stay where they are or maybe pick up a bit. So real wages will probably be growing again next year for the first time in about 5 years. So that's helping the consumer side of the equation. As I said, labour market and sentiment, as we've already talked about, what it tells you is the real risk really comes down to that debt servicing component. The last time we had a genuine consumer recession in Australia was 2008. And back then, the debt service ratio, so how much of income do we have to use to service our home loans and credit cards and the like? Well, it was about 10% of disposable income. To get that ratio back up to that critical level, you would need a Reserve Bank cash rate right now of about 6%. We're at 4.35%. Another rate rise takes us to 4.6%. So we're starting to get close to that danger zone, but not actually up to that point. So it's going to be a close run thing in some ways. And the one other part of the story I think we should just mention here on that household income side, all the focus is on interest rates, debt servicing costs, falling real wages. But the other big drag on disposable income at the moment is taxes. Income tax is growing at a very rapid rate. It is obviously a drag on what's left to spend at the end of the day. It's happening partly because of ongoing jobs growth. It's happening partly because growth has picked up a bit. But even so, taxes per person is growing at the fastest rate we've seen in about 10 years. So, the government's got to take some of the blame for the pressure on households at the moment. And it's certainly worth keeping that in mind when we go back to the debate about the Stage 3 tax cuts, which are due to take effect in the middle of next year. So, those that want to cancel them or redirect the money somewhere else, need to explain how the tax side of the equation is impacting on households as much as interest rates are.
These are the tax cuts that were actually introduced a while ago, right?
Yes.
They've just been phased in years after the fact.
Yes, I mean, the common argument you hear, of course, is, well, these tax cuts are going to be unfair because a lot of the money will go to the higher end of the income range. But, the clue there is in the name, stage 3. So there's been a stage 1 and a stage 2 tax cut.
At the lower end of incomes.
Went to the lower end of the range. So
and forgive my ignorance, but I believe stage 3, is it 30% up to 180 or something like that now?
Yes, I think that's the number. I don't have them in the mind as such, but even lower income households will get some benefit from these stage 3 tax cuts. But in terms of the dollar amount, the biggest bit does go to those on higher incomes. But in the end, it's that higher income group that actually pay most of the net taxes in Australia. Lower income households, lower to middle income households, they tend to get back more from the government than they actually pay in taxes when you add on all the various payments that governments make and so on. It's the top end, the top 25% of taxpayers in Australia are the only group who pay net tax. They pay more than they get back from the government. So I think it's only fair that they get some benefit as well.
All right. Well, Michael, thank you so much for coming in. You've been very insightful, very interesting to listen to. That crystal ball still had some left and right options there, so I'm not sure what to expect in 2024. But thank you so much for your time. Really appreciate you coming in, and look forward to having you again one day.
Well, thank you very much. And let's, of course, not forget there's a US presidential election at the end of 2024 just to keep the interest going through the next 12 months.
That will be interesting. Yes, definitely. All right. Thanks again, Michael.
Thank you.